Salesforce, ticker CRM, traded as high as $265 this year. Today, the software application company sits at $209, down 43% from the top. That gap between the high and today's price is where value investors and growth investors start reading two totally different stories. JPMorgan raised its target to $250 this month, Citi to $204, yet the stock keeps sliding back within days of each call. By the end of this video, you'll know whether Salesforce's cheap multiple is a genuine bargain or a warning about slowing growth beneath the AI hype. For a value investor, the numbers look almost too good. Revenue climbed from $31 billion to over $41 billion in a few years, EPS jumped from 21 cents to 7.80, and free cash flow more than doubled to $14.4 billion. At a price-to-earnings ratio of 24, Salesforce trades cheaper than ServiceNow's 80 and Workday's 62, with a PEG ratio of 0.87 priced below its own growth rate. For a growth investor, the picture is murkier. Agentforce, the company's AI product, grew revenue 205% to $1.2 billion. But current remaining performance obligations, the contracted revenue set to convert into cash over the next year, grew just 14%. That's the real test of whether AI demand is turning into locked-in business or just a headline. Add this: Salesforce returned $27.5 billion to shareholders in a single quarter, more than its entire annual free cash flow, while its current ratio sits below 1. Soros Fund Management closed its position completely. The evidence leans toward caution, not a bargain. Bookings growth of 14%, far behind Agentforce's 205% headline, suggests the slowdown is real. Still, $41 billion in revenue and rising free cash flow aren't nothing. Watch the cRPO number in the August 26th report. That single figure settles which investor is right. Subscribe if you want the cRPO number broken down live. This isn't financial advice. Always check the filings yourself.